Good afternoon, ladies and gentlemen. Welcome to our research huddle for today. For the paper entitled What Drives Cross-Border Bank Flows, authored by Dr. Veronica B. Bayangos and co-authored by Dr. Ramon Moreno, former head of economics for Latin America and the Caribbean for the Bank for International Settlements. Before we proceed, allow me to introduce our speaker for today. Dr. Veronica Bayangos is currently principal researcher at the BSP Research Academy. Prior to joining the academy, she served as the director of two of the most transformative research units in Philippine banking: the path-breaking Center for Monetary and Financial Policy, 2015 to 2017, the leading-edge Supervisory Policy Research Department from 2018 to 2021. She holds an MA and Ph.D. in Development Economics from the Institute of Social Studies of the Erasmus University in the Netherlands. Her published works cover the areas of empirical macroeconomics and international economics, monetary and financial policies, macroprudential policy, and macroeconomic modeling and forecast. Ladies and gentlemen, Dr. Veronica Bayangos.
Thank you very much, Jade, for that very generous introduction. By the way, my co-author is here, Dr. Ramon Moreno, straight from the Switzerland. All right. Good afternoon, everyone, to all the participants of this research huddle. Dr. Ramon Moreno and I have been working on this topic for the past 3 years. And we would like to thank our colleagues from the financial supervision sector, headed by Deputy Governor Chuchi Fonashier, Assistant Governor Lynn Javier, and our colleagues from the Department of Supervisory Analytics for sharing with us a very beautiful data set on bank level cross-border financial report. There was a baseline discussion paper that was uploaded on the BSP website last year on this particular topic. But for this research huddle, we updated the paper to include developments up to the COVID-19 pandemic, such that my presentation will cover the developments from March 2015 to March 2023. Now, in the next slide, our motivation rests with renewed interest on the literature that focuses on the important drivers and impact of cross-border banking flows. Now, in general, studies show that capital flows can finance investment. This is the traditional theory, consumption, and economic growth. But excessive and volatile capital flows to emerging market economies, or EMEs, often lead to sharp reversal or sudden stop, credit, and output contraction. Now, more recent studies point to significant evidence on drivers and impact of cross-border banking flows. Now, cross-border banking flows are capital flows that are channeled through the internationally active banks. Internationally active banks could be domestic or foreign banks. Now, the focus of the discussions on the impact of cross-border banking flows is how much of this is channeled into domestic credit through the international active banks. Now, more recent studies point to significant evidence on cross-border transmission of monetary policy through bank lending and the sources of heterogeneity in the transmission across types of banks in EMEs. Now, as banks' decisions play a central role in the effects of changes in domestic monetary policy, understanding the differences in banks' responses to monetary policy shocks is key, as these capture the specific characteristics of banks. Now, these characteristics that seem relevant in the cross-border monetary policy transmission include banks' cross-border positions, their funding structures, and their levels of capitalization. We expect this to affect the supply of domestic credit and consequently the domestic credit cycle. Now, given these discussions, it is then useful to revisit what drives cross-border bank flow. So that's our motivation. Now, in this paper, in the next slide, we estimate the drivers and their impact on cross-border bank flows, as I mentioned earlier on, from March 2015 to March 2023, using data from a destination of capital flows, emerging market economies such as the Philippines. So destination country ang Philippines. We will then estimate the relationship between bank flows and domestic credit cycle, focusing on the responses of domestic and foreign banks to credit supply. Now, we emphasize in our analysis the importance of specific bank features such as the capital and liquidity positions of individual banks in monetary policy transmission. Now, a crucial objective of this paper is the construction of three unique bank-level database from the financial supervision sector. First is the cross-border financial position, which is the source report on cross-border claims and assets. When I say claims, I'm also referring to assets and cross-border liabilities. This source report helps us to examine drivers of cross-border bank flows. In short, the report allows us to distinguish factors driving both the liability side and the lending side or the asset side, and by type of bank or banking group. Second, a database of bank-specific characteristics from the financial reporting package. The database helps us to estimate the relationship between bank flows, the health and performance of banks, and of the domestic credit cycle. Now, finally, a database on monetary, financial market, and real sector indicators help us to estimate the response of cross-border bank flows from monetary policy actions, changes in asset prices such as exchange rate, and real sector indicators such as growth and inflation. Now, the next question is, how do we monitor cross-border bank flows? In the next slide, the question is, how do we monitor cross-border bank flows? As I mentioned earlier on, cross-border flows are channeled through internationally active banks. Flows are booked as cross-border claims or assets and are typically composed of loans and investments in treasury securities abroad. Flows are also booked as liabilities and are largely deposits, borrowings abroad, and bills payable. Of course, you have equity, which are added to liabilities to balance the cross-border claims. Now, ano naman yung cross-border financial position? This refers to the asset and liability position vis-a-vis banks and non-banks located in a country other than the country of residence of the reporting banking office, which in this case is the Philippines. Now, this definition is consistent with the definition of the Bank for International Settlements in its international banking statistics, which have been used in a number of studies. However, BIS statistics are aggregated and traditionally focus on liabilities or bank liabilities in the destination country. Now, by contrast, this report explains detailed sources and uses of both, meaning our report that we used in the paper. The report explains detailed sources and uses of bank-level gross liabilities and gross assets in a destination country, the Philippines. Finally, developments in cross-border financial position typically affects banks' overall balance sheet. Now, in the next slide, to continue, the BSP requires banks to report their cross-border financial position starting in September 2014 to provide the BSP with a comprehensive view of potential financial risk and transmission channels emanating from foreign counterparties of Philippine banks. Now, this report contains responses from 57 internationally active banks. As I mentioned earlier, on both domestic and foreign banks. Now, in this data set, we were able to use quarterly bank level data on cross-border positions of 57 banks from March 2015 to March 2023. Now, in the next slide, based on this report, the next slide shows the movements in cross-border financial positions, again, from March 2015 to March 2023. Now, what you can see in the graph, the left side, is that prior to COVID-19 pandemic, gross financial position, meaning the sum of assets and liabilities of banks, has grown by an average of 9.9% from March 2016 to end March 2020, mainly to service corporates and overseas Filipino workers. The average growth, however, dropped by 0.1%, which is not that big, from June 2022 and March 2023. Now, these exposures represent about 14% of the total banking assets as of end March 2023. Now, but these exposures have been volatile, especially during the past decade or so, following the taper tantrum episode in 2014. Now, in general, um, the significant movements in cross-border positions. Okay, so that's the slide. In general, the significant movements in cross-border positions were driven by the series of reforms to improve the resilience of the economy and of the financial system. These reforms include 11 waves in the foreign exchange regulatory framework starting in 2007, the formal shift in the monetary operations of the BSP to an interest rate corridor system, and the adoption of strategic financial sector reforms, including the implementation of Basel prudential reforms, and the entry of foreign banks in 2014. Now, as of end December 2029, we have 29 foreign banks authorized by the BSP to operate in the Philippines. Now, let me move on to the asset side or the claims side. What is driving the claims side is the strong global risk appetite and a drop in the US Treasury yields that supported cross-border lending and investment of Philippine banks. Lending to non-financial corporations grew by 33%. Investment in dollar-denominated debt securities increased by 47% in September prior to the pandemic. However, in March 2020, majority of Philippine domestic banks, large domestic banks, counterparties did not extend maturity period of their exposures, mainly in the form of repurchase agreements following the strains in the offshore dollar funding markets. This led to a reduction in cross-border financing by more than 30%. However, debt securities subject to market valuation grew by 71%, while claims on non-financial sector by 8.1%. On a net basis, so that's your orange graph, recent movements in net cross-border claims were driven by the decline in gross liabilities of domestic UKBs following the outbreak of the pandemic in March 2020. Now, in figure 2, so that's your bar graph here, we present the cross-border positions of this time domestic UKBs and foreign banks for end March 2018, March 2020, and March 2023. Now, in general, about 83% of the gross claims and liabilities have been driven by large domestic UKBs, while foreign banks only account for 17%. What we can also see is that the movements from March 20 to March 2023 were marginal for both UKBs and foreign banks due to the impact of the global pandemic. Now, let me move on to the research questions. We posed 3 research questions in this paper. In this paper, a broad question is, what drives cross-border bank flows? Then we identified narrower questions. One is, does domestic credit cycle influence cross-border liability or asset position of internationally active banks? Another question is, do movements in cross-border bank flows differ by banking group? Now, in the next slide, here we share our contribution to empirical studies. Our results add to the current findings on drivers of bank flows, as I mentioned earlier on, using cross-border financial positions from bank-level source report. We also add to the recent research on mechanisms by which monetary policy or other shocks affecting international banks are transmitted across borders. Now, a widely studied channel is the bank lending channel of monetary policy. A similar framework has been used to assess how monetary policy can affect cross-border lending in a source country or cross-border liabilities in a destination country. Now, Baskaya et al. In 2017 studied how capital flows affect the local credit supply in emerging markets and the mechanisms behind an international credit channel using credit register data for Turkey from 2005 to 2013. What they found out is that the reduced capital flows would tend to reduce credit supply in larger, more capitalized banks in the destination country, and that these effects are stronger for domestic banks. Now, there are also insights on the diverse drivers of cross-border bank financing using the bank risk-taking channel. Now, under this channel, an increase in the source country policy rate, in this case, Fed funds rate, raises financing costs, lowers bank risk tolerance and willingness to lend to emerging market economies. Now, along with reduced cross-border financing, the rise in the US policy rate would tend to depreciate the currency in destination countries, reducing the net worth of domestic banks with foreign currency liabilities, and their willingness to lend. Now, another paper, which is one of the basis for our paper, is that which was written by Correa et al. In 2021, where they analyzed the impact of monetary policy tightening using BIS international banking statistics. Now, we draw on the literature on the bank lending and risk-taking channels. There are broad similarities with Baskaya and Correa et al. We looked at the universe of internationally active banks located in the Philippines to examine the drivers of bank flows by examining the cross-border financial positions. Now, we extend earlier studies that have focused on cross-border liability positions to include the impact of shocks on the asset positions of a destination country. So in this paper, dalawa ang kinuha namin, the liabilities and the asset position. Now, by matching the cross-border report with bank-specific characteristics from the financial reporting package, we were able to estimate the influence of various factors on credit supply responses between domestic and foreign banks. We were also able to get some insights on the impact of the global pandemic on cross-border financial positions. Now, but our estimation approach differs from Correa and Baskaya because of our disaggregated data set. We were able to use instrument variables and employ a panel generalized method of moments to address the endogeneity issue and to control for the banking system's unobserved component of credit supply that can be related to credit demand. Now, let me give you a snapshot of our results. First, in the next slide, both external and domestic factors drive the cross-border financial positions. Now, external factors here would include measures of global risk appetite, such as VIX. Before the pandemic, the average real GDP growth of advanced economies was significant in driving cross-border financial positions. Now, domestic factors include liquidity and capital buffers, we included real exchange rate here. And in between indicators, we have the spread or the difference between the BSP policy rate and the US Fed funds rate. Now, as I mentioned earlier on, global risk appetite dominates in influencing cross-border liability position. The spread between BSP policy rate and Fed funds rate has a significant impact on cross-border asset position. What this means is that monetary policy plays an important role in decisions by banks on portfolio rebalancing. But the contributions of global risk appetite and spread between policy rate and Fed funds rate increased during the COVID-19 pandemic. And finally, an important finding of our paper is that the domestic credit cycle affects cross-border asset position of both domestic and foreign banks. Now, what I would like to do in the next minutes or so is to present to you our empirical model, a bit technical, but this is also useful. The identification strategy that we use, the robustness checks, the results, and here we would like to share the insights from the ongoing research update that we are doing, and finally, the conclusion. Now, I mentioned this earlier on in the next slide, that the model setup of our empirical model is like a balance sheet with both claims and liabilities as dependent variables. That's your Y. And then your equation 1 presents the drivers for both cross-border claims and liabilities. In the next slide, what we can see here is our approach in identifying external and domestic factors driving cross-border positions. For instance, under external, and we basically use Kopke's 2019 paper, the external drivers include indicator of global market uncertainty. The domestic includes macro financial indicators such as growth, inflation. And then you have the in-between indicator like the differential interest rate between US and Philippine lending rates, BSP and US Fed funds rate. Now, we also use the components, specific components of cross-border assets and liabilities. We also controlled for credit demand that may be generated by bank flows in cross-border assets and liabilities. And finally, an innovation or an important measure or variable in this model is the domestic credit supply cycle. Basically, it is the deviation of the banking system credit from one-sided HP filter trend. We removed the idiosyncratic or random component related to credit demand. So that's one of the innovations we did for this paper. Now, let me move on to the next slide on the robustness checks. Again, as I mentioned earlier on, we use panel generalized method of moments to account for endogeneity from March 2015 to March 2023. We used dummy variables for the impact of foreign exchange liberalization reforms, sterilization episodes, and even COVID-19 period. We used alternative specifications. We checked for second order autocorrelation, including instrument variable over identification. And finally, we also checked the standard error of the regression, the model itself. Now, let me move on to the results. What you can see here is that, as I mentioned earlier, on dalawa yung ginawa namin, you have the asset position and then you have the liability position. I'll start with the liabilities position. Again, our results yielded some important insights for policy. First, so that's your second column. The result shows that cross-border assets VIX, or a measure of global risk aversion, the health of individual banks as measured by the gap between common equity tier 1 from the threshold of 6% drive cross-border liabilities. Now, this finding confirms other studies findings such as those of Choi and Forseri in 2019 that global factors also affect sources of bank funding. Now, so next slide. For this time's asset position naman tayo, the results show that both, again, external and domestic factors drive cross-border asset position. Intuitively and based on the literature, the cross-border asset position reflects supply of cross-border assets from Philippine banks. About 85% of Philippine banks' cross-border assets are in dollars, US dollars, and are largely channeled to advanced economies. What we can see here is that the interest rate gap, or the difference between the BSP overnight policy rate and Fed funds rate, has a negative impact on claims. In a separate regression, we also found that banks, particularly domestic UKBs, reduced their portfolio abroad following increases in domestic monetary policy stance. So that's your BSP overnight policy rate. Now, in this same model, the health of individual banks as seen in liquidity gap and CET1 gap are significant in driving cross-border claims. Now, so next slide naman, what we can see here is that changes in domestic credit cycle affect cross-border asset position. So this is one of our important findings. A higher CCY, that's your credit cycle, implies greater ability of the banking system to expand lending abroad, specifically domestic cycle of domestic UKBs and foreign banks. The coefficient is positive and significant in driving cross-border assets. Now, there are also bank-specific characteristics such as liquidity and capital buffers, which have a positive impact on banks' asset position. Now, in the next slide, we summarize the results of our regressions to see the relative contributions of the drivers of cross-border positions prior to the pandemic and through the pandemic. So that's prior to the pandemic, so that's March 2015 to December 2019, and compare that with March 2015 to March 2023. Our results show that external factors have bigger contribution to cross-border asset position, domestic factors to cross-border liability position. What we can also see here is that VIX and the differential rate have bigger contributions through the pandemic period. But the contributions of both these factors have increased during the early phase of the pandemic. This could be due to the series of reductions in the BSP policy rate that started during the last quarter of 2019. Now, at this point, in the next slide, we would like to tease out some initial findings of ongoing updates of the paper. One is on the impact of monetary policy shocks on cross-border financing and assets. If you recall, diba, we used the differential rate between BSP policy rate and Fed funds rate. What we are doing right now is we are disentangling the impact of the BSP policy rate and Fed funds rate on central bank financing. Now, for the Fed funds rate, we use the effective Fed funds rate from the Federal Reserve Bank of Atlanta. But this time, we are using the shadow Fed funds rate to account for the impact of US quantitative easing. What we found out is that the increase in BSP policy rate, Fed funds rate, and even the shadow Fed funds rate reduces cross-border claims, liabilities, and net cross-border assets. The difference, I mentioned this earlier on, even the shadow Fed funds rate tends to reduce net cross-border assets of both domestic and foreign banks. We are still refining our simulations, and maybe we could present this in another research huddle. Now, to conclude, Our paper offers some takeaways. One is that the cross-border financial positions of banks are potentially open to possible disruptive spillovers given the global factors. Spillovers given that global factors drive cross-border flows to the Philippines. Domestic factors are equally important drivers of cross-border flows to emerging market economies, including the Philippines. There is a role for conventional monetary policy when it comes to decisions by banks on portfolio rebalancing, which is this finding is very important. It is useful to include analysis on credit cycle dynamics, specifically domestic credit cycle, in the presence of cross-border bank flows. And finally, it is relevant, it is useful to use the bank level cross-border financial position in assessing the financial performance of banks. I will stop here. Thank you very much.
Thank you very much, Dr. Bayangos. Okay, the floor is now open for questions. If you're joining us online, please feel free to place your questions in the chat box. Anybody from the floor? Dr. Mariano.
I'll just ask a few questions about the empirical part. In estimating the equations, you used instrumental variables estimation, and the instruments used were the lags of the dependent variable.
Yes, yes. And also
if there is some time dynamics in that variable in the credit assets, is it?
yes.
Are you not introducing an endogenous variable as an instrument? Would it not be possible to use alternative instruments to see how the estimates might come out? Because you might still miss endogeneity completely with the choice of the instruments that you've used.
Okay.
If, for example, it's autoregressive,
Right.
miski isang order lang, autoregressive one, because then you'll have correlation between current and all past values of the dependent variable, and you're using that as an instrument for other endogenous variables that show up on the right side.
That's but okay, go ahead, Ramon.
So we can track that for the dynamic.
Yeah,
The autoregressive process.
and check it out. Yeah.
Yes, thank you. Yes, no, I was just saying that, yeah, it would then make sense to look at the dynamics of the series that are being used as instruments
As instruments.
to
Yeah.
verify that it's appropriate to use.
Uh-huh.
My approach naman, Dr. Mariano, is a bit siguro more practical. Kasi if there will be problems in the endogeneity of using instrument variables, it would show up immediately in your residuals, right? If there will be problems. But here in this approach, what we did was we checked for the standard error of regression of the model itself, such that all residuals have been correct, have been tested. So that's that's the approach that we used in this exercise, because it's using instrument variables for balance sheet data or balance sheet source is really very difficult.
Right.
So what we did was we looked for instrument variables that are that would not contribute to widening of the residuals. So we checked all the residuals to make sure that if there are problems in that aspect, then then the model will still hold.
Yeah, there are other tests
Right.
for determining whether you have really corrected appropriately for
Right.
for endogeneity or not.
Well, that's a good one, Dr. Marian. We will do more tests.
Okay, other questions? Okay. For now, there's none online from our 107 online participants. Okay. Okay. I think they need time to digest.
Maybe another presentation.
Someone might want to make some comments.
Okay. So- Okay. Okay. If there are no further questions, then we want to thank everybody for joining us in this research huddle. And let's all give a warm round of applause for Dr. Bayangos and her co-author, Dr. Moreno. Thank you very much.